In today's episode, I'll talk about two interesting stories. In the first one of the day, I'll talk about how a small policy tweak in government bidding is trying to fix the massive cracks in India's infrastructure construction engine. And in the second story of the day, I'll talk about how Bajaj is stepping in to rescue KTM and why an iconic European bike brand might soon be run from India. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 28th of May. Something very unusual happened recently. CareEdge, which is a ratings agency, put out a note about a minor change in bidding norms, which is something to do with performance securities. Now, I know for most of us, this is a piece of news that we would normally skip past and not care about. But when our team paused to understand the reason behind all of this, we realized that it is actually trying to solve a huge and a very real problem, which is that India is losing lakhs of crores of rupees in taxpayer money and is wasting time on delayed infrastructure projects. And to fix exactly that, the government is tweaking how companies bid for these projects. And this very, very small change is actually opening up a deep and a very complex world. This is a world that is shaping India's physical future in a way that most of us do not even see today. This is the EPC sector, which is short for engineering, procurement, and construction, which is how a large chunk of India's infrastructure is being built today. You can think about roads, power lines, ports, metro, water pipelines, and whatnot. And this very sector, while it may sometimes look like a dry corner of the economy, is both indispensable to India's growth and at times dangerously fragile. So let me take a quick step back and look at the bigger picture. See, after the pandemic hit, India began to bet big on capital expenditure. If you look at the numbers, construction alone is responsible for around 7 to 10% of all the value that is being added in our economy right now. Now, that is a massive chunk, and the biggest force behind this is the central government, which is putting a lot of money into all kinds of public infrastructure like highways, rail freight, corridors, seaports, and massive logistics projects. You might ask me why? That is because we are a growing economy. Our cities are expanding, our population is rising, and more Indians are being pulled into the formal economy right now. And that, of course, is great news on one hand, but the thing is, if we want this growth to be meaningful, we need the hard infrastructure to support it. We cannot have economic growth as such without reliable water supply, without reliable power, transport, or even housing for that matter. And frankly speaking, we are starting from a relatively weaker baseline. There is basically a lot of catching up that India has to do as a country. So the government is now stepping in. They have announced a massive pipeline of infrastructure projects worth a massive 147 lakh crore rupees. And out of this, about 72% or nearly 92 lakh crore rupees of work is being channeled through the EPC route. And that is exactly what I'll be explaining in a little more detail in today's episode. I'll explain how this works first. See, there was a time when the government used to handle big infrastructure projects itself. A public department would be in charge of designing, managing, and also executing everything. They would hire architects, they would source material, and they would coordinate multiple contractors. But as the scale and complexity of projects started to grow with things like expressways, airports, solar parks, etc., the approach stopped making sense. The government did not have the expertise, nor did it have the time to micromanage everything. So then they started experimenting with different models like BOT, which is build, operate, and transfer, and HAM, which is hybrid annuity model. Now, these were all efforts to pass some of the project risk to private companies in exchange for better execution. But the thing is, none of them were really perfect. The key question was always, how much responsibility should we shift to the private sector? Too little and the project stalls, but too much and the companies will not even show up to bid in the first place. So eventually, a model called EPC, which is engineering, procurement, and construction, started to become the sweet spot of sorts. Now, to give you context, under EPC, a private company signs a contract that says, we'll build this project for you end to end for a fixed amount in a fixed timeline. And the government, on the other hand, simply defines the final outcome that it wants. For example, a highway between two cities within 500 crore rupees completed in 2 years or so. And once that part is done, the government sort of takes a step back. The contractor then handles everything else, right from the engineering part to the procurement of materials and also the construction itself. And most importantly, the risk of cost overruns overruns or delays fall squarely on the contractor. And that is why EPC projects are also called turnkey projects. The contractor basically does all the hard work and the government just has to turn the key and start using the project once it is completed. Now, this model has now become sort of the go-to for all kinds of infrastructure. This could include renewable energy parks, roads and expressways, urban metro lines and bus terminals, water supply for household and farms, defense projects, and even industrial plants. The range is basically quite large. But the thing is, running an EPC company is not at all easy. In fact, it is one of the most complicated and high-stakes businesses out there. To begin with, you need a steady pipeline of work. That means constantly tracking government tenders and also qualifying for them. Now, most tenders ask you for proof that you have both the technical chops and the financial strength to deliver the project. And among those who qualify, it is usually the lowest bidder who wins the contract. And that makes everything extremely competitive. Now, you can try and win an entire project as the main contractor, but if you're a smaller company, you might only get to a subcontract part of the work from someone else. But either way, you need a steady order book, which is ideally 3 to 4 times your annual revenue in order to only stay in business. And once you even win your contract, your next challenge is financing it. Even if you're not directly funding the project, you will still need to arrange bank guarantees, manage cash flow, and also maintain enough working capital to cover your day-to-day costs. That's because the initial stages of an EPC project are cash incentive, where you might need to pay for materials, labor, and machinery long before you even get paid by your client. You could of course get mobilization advance of 5 to 10%, but that does not go very far, to be honest. And then comes the land part. Large infrastructure projects need a lot of land for obvious reasons, but land acquisition is often where projects also get stuck. And that is because people don't want to give up their land. There are compensation delays that happen, or rehabilitation is not even sorted in some cases. The government is trying to pre-acquire land in many cases and even create common utility corridors. But for EPC companies, land remains one of the biggest reasons for delay. And even if the land is sorted, you have to clear sort of a jungle of regulatory approvals, which are environmental clearances, pollution board permissions, safety certificates, labor compliances, and whatnot. And it is only after all of this that construction can even start in the first place. And even when it does, you then have to move fast and work smart. First comes the engineering phase, where you finalize the designs and the layouts. Then you move to procurement, which is sourcing steel, cement, equipment, and so on. And then finally comes the construction phase. And at this point, time is almost like money. You are being paid in fixed stages for hitting fixed milestones. And if something slows you down, payments also get delayed as a result of it. But meanwhile, your costs are still rising. The lag is very brutal in many ways, and it is one of the biggest financial risks in this business. And that is why execution is a very important key here. You need to source materials at the best possible prices, you need to build robust supply chains, and you need to manage a vast workforce like welders, electricians, masons, operators, etc. And at the same time, you also have to deal with issues like commodity price swings, because if things like steel or cement prices rise, your entire project's economists can be wiped out all of a sudden. And then there are also project-specific nightmares. Imagine you have to build a railway line in the hilly terrain of the northeast. You might need to bring in huge girders that are 30 or 40 meters long, and the logistics alone here could be a project in itself. So in many ways, every job is different and each one sort of throws in its own curveballs. And all of this makes EPC a high-risk, high-pressure business. And that is why over time it has been dominated by large players like L&T, Adani, and some others. They have the money, the people, and also the systems to deal with this entire chaos. And their size gives them a big advantage that they can weather out delays, they can diversify their project risk, and they can raise cheaper capital. But even with that, the sector is not a closed club as such. There are hundreds of smaller firms, each of them trying to find their own niche. And that makes bidding extremely aggressive. Since tenders are only awarded to the lowest bidder, companies usually quote prices that are razor thin. And sometimes they do this because they found a way to be more efficient, but more often than not, they are just taking a bet, hoping that things do not go wrong for them. And when they do, it leads to half-finished projects, delays, or low-quality execution. And this gets worse when demand slows down. If, for example, the government is not releasing new contracts, maybe because of elections, monsoons, or budget delays, everyone sort of rushes to grab whatever little tenders are available. Recently, for instance, highway construction projects under the Bharatmala scheme slowed down. And as a result, companies began fighting over unrelated projects just so that they could keep their teams busy. And that brings us back to the news that I started with. The government knows that this is a problem. When contractors bid too low, the project is at risk. So to stop this from happening, the Ministry of Road Transport and Highways made a change here. Earlier, if your bid was much lower than expected, you had to put an extra 3% as additional performance security. But companies found a way to work around it. But now there is a new rule. The lower your bid, the more money you have to commit upfront. You can think of it like this. If you say you will do something for an unusually low price, you also need to put more of your own money at stake to prove that. And that way, only those who are genuinely confident and not just desperate will take this risk. Will this fix everything? No. EPC will always be tough because after all, you're trying to execute huge, complex, and physical projects in a country as chaotic as ours. But that said, this rule will definitely add a lot more sanity. It rewards seriousness, it raises the cost of making empty promises, and that's exactly what we need right now. Because building India cannot just be about announcements, it has to also be about delivery, about the roads we drive on, the water that flows through our taps, and also the power that lights up our homes. On that note, let's move on and talk about the second story. See, something very interesting and big is happening in the space of motorcycles, and it is not the kind of story that we hear every single day. See, one of Europe's most well-known motorcycle makers, which is a company called Pierer Mobility AG, has found itself in serious financial trouble. Now, this for your context is a company that owns brands like KTM, GasGas, and a bunch of other big names in the world of performance motorcycling. Things got so bad for them that they had to file for insolvency protection. In very simple words, this means that the company could not repay its loans on time and they had to ask the courts for help to avoid completely shutting down. Now, bankruptcies in businesses are not exactly rare. Companies run out of cash, they make bad bets, or they get hit by unexpected crisis all the time. But what is unusual over here in this case is what happened after this. See, an Indian company, which is Bajaj Auto in this case, has decided to step in and rescue Pierer Mobility. Bajaj is planning to spend roughly 7,600 crore rupees to stabilize this company. But obviously, this is not really a charity move. Bajaj will get a majority control of Pierer Mobility, and if the deal goes through, KTM, which is a legendary European brand, could soon be run by an Indian company, which is Bajaj. But to understand why this is a big deal in the first place, let's very quickly step back and understand who these companies are and what brought KTM to this point and why is Bajaj even doing this in the first place. Let's start with Pierer Mobility AG first. Now, this is the largest motorcycle manufacturer in Austria and it is among the top companies on Vienna's stock exchange. But unlike other companies, let's say Japanese ones like Honda or Yamaha that make a wide range of vehicles right from scooters to small city bikes to even powerful super bikes, Pierer Mobility focuses entirely on high performance machines. Now, these, mind you, are not the regular bikes that you and I would use to go to your work or college. They are designed for people who love to speed, off-roading or racing for that matter. They are engineered for thrill seekers in some sense. And at the very center of all of this is KTM. Now, KTM has built its entire identity around racing. It has a very strong presence in MotoGP, which is the world's most elite motorcycle racing league. Every year, it spends roughly 665 crore rupees just so that it can participate in the MotoGP. Now, that obviously is a massive amount of money, but it is not just about passion for them, it is a strategic choice. Basically, by being a part of the MotoGP, KTM is able to prove to the rest of the world that its engineering is world class. And obviously, as a result, it also gains a lot of credibility and admiration from serious biking enthusiasts from all across the world. But this extreme focus on performance is also what makes the company fragile in one way. The thing is, building these bikes is very expensive and selling them in large volumes is very difficult. And when the economy slows down or inflation rises, problem is people stop spending on luxury items like high-end motorcycles. Basically, if you're worried about your next EMI or your electricity bill for that matter, you are obviously not going to splurge on a 10 lakh rupee bike, right? That is the harsh truth, and KTM has faced this problem more than once. In fact, this is the third time that the company has hit rock bottom. Back in 1991, KTM faced its first big collapse. At that time, the company was making more affordable bikes, but poor business decisions and stricter regulations pushed the company into insolvency. It was almost the end for them, but then KTM took a bold step. Instead of trying to be everything for everyone, they decided to become a brand for performance. They went premium and they focused on racing and engineering, and that helped it become stronger. But that said, this strategy also meant that KTM became heavily dependent on a very small and niche market. Its bikes were too expensive to sell in countries like India, where most buyers still care about things like fuel efficiency and price. And that is exactly where Bajaj Auto entered this picture. See, in 2007, KTM did a deal with Bajaj. Bajaj got a minority stake in the company and they got the rights to manufacture KTM's smaller bikes in our country, India. And this partnership turned out to be a game changer for both of these companies. Bajaj brought the ability to manufacture efficiently and affordably, while KTM brought in brand appeal and engineering know-how. and together they both built bikes that were premium in feel but cost effective to produce. Now, these bikes were made in India and they were sold across the world, right from the US to even Europe. Basically, India became the factory while Austria stayed the brain behind the designs and the engineering. And the partnership was so successful that it encouraged Bajaj to slowly increase their stake in the company. Over time, it went up to almost 50% in Pierer Bajaj AG, which is the holding company that owns Pierer Mobility AG. But that said, because this partnership was doing well, KTM started taking some very risky bets yet again. They began exploring new product lines like electric bicycles and even sports cars while also increasing their MotoGP spending. One of the biggest missteps here, at least in hindsight, was jumping heavily into the e-bicycle segment during the pandemic. The context here is that at that time, the demand for electric bicycles had surged, but that demand very quickly faded and KTM was left with unsold inventory roughly worth 9,500 crore rupees. And this of course added a huge burden from its already high expenses from racing and R&D. And by 2024, the company's finances were under some very serious stress. While it still had a decent top line where they were making around 19,000 crore rupees in annual revenue, they were also carrying a massive debt of nearly 15,200 crore rupees. But then came the worst blow. Global motorcycle demand dropped sharply and KTM's own sales fell by 22% in just 1 year. With around 230,000 unsold bikes lying in its inventory, the company had to halt production for 3 months. And the numbers were very scary here. KTM publicly admitted that it had lost almost all of its equity capital, half of its shareholder value had been wiped out, and on top of that, they had to repay around 3,300 crore rupees worth of bonds that were maturing soon, and they simply did not have the cash to do that. So with time running out, KTM and its parent company had absolutely no choice but to file for insolvency protection in Austria. Now the Austrian courts then stepped in and laid out very clear conditions. The company had to repay at least 30% of its dues by May 2025. And if they failed to do that, they would be forced to shut down. Now this was a serious crisis for KTM, but for Bajaj, it was a big opening. After spending nearly 2 decades in helping KTM grow, Bajaj had a lot at stake. Letting the company collapse would have been a big blow, but stepping in now could allow Bajaj to take control of a legendary global brand, which is something that fits perfectly into their long-term ambitions. So therefore, Bajaj went ahead with a rescue plan worth 800 million euros or roughly 7,600 crore rupees. But obviously, they didn't just give a check. They offered 200 million euros as immediate bridge financing, which is basically an emergency loan to keep the company afloat. And the remaining 600 million euros would be raised as loans by Pierer Mobility, but Bajaj promised to back these loans. In other words, Bajaj told lenders, give them the money and if anything goes wrong, we'll make sure that you get paid. Now that made lenders of course feel safe and enough to agree to do this. Now obviously Bajaj is not doing all out of kindness. In return, it has secured a special right which is a call option, which is to buy a 50% stake in Pierer Bajaj AG. Now Bajaj can choose to exercise this option at any point in time before May 2026 by paying a simple sum of 50.7 million euros. And if they do that, Bajaj will then become the majority owner of Pierer Mobility and obviously by extension all the other brands inclusive of KTM. And when that happens, Stephen Pierer, who is the man who's currently running KTM, will have to step down from active leadership. Now mind you, this deal is not just about fixing someone else's mess. It also solves a huge problem for Bajaj. See, Bajaj has always been a big player in India's commute bike market because they have brands like Pulsar and Platina. But the problem is that they never had a premium global brand of their own. But now with KTM, they get everything in one shot. A high-end brand, a well-established global sales network, and access to cutting-edge electric vehicle technology. And obviously, trying to build all of that from scratch would have taken many years and would have cost far more to the company. But for KTM, on the other hand, this deal is nothing short of a lifeline. Manufacturing in Europe had become too expensive, and moving production to India can help cut costs while keeping quality quite high. Bajaj already makes KTM smaller bikes, and now even mid-size models might be made over here. But Bajaj will not obviously keep pouring money into loss-making ventures. The electric bicycle business might be sold or even shut down, and even KTM's expensive MotoGP projects is being reconsidered now. The aim is basically to make KTM leaner and more financially stable without losing its identity as a performance-first brand. And if all of this goes according to as it's planned, it could change the global motorcycle market in a very big way. A cost-efficient KTM which is backed by Bajaj could become a very serious competition for brands like Royal Enfield, especially in the mid to high range segment. It could also inspire Indian manufacturers to dream bigger and think more globally globally in many ways. But that said, none of this will obviously be easy. Running a brand across different continents is obviously very complicated. Bajaj has to keep its costs low while making sure that KTM still feels premium to everybody. They will have to navigate the shift to electric vehicles as well. But that said, if there is one partnership that might just pull it off, it could really be Bajaj and KTM. One brings scale and money, and the other brings brand value and engineering. So this could really become the next big chapter in global motorcycling businesses. That brings us to the end of the two stories of the day. With that, let's move on and talk about the quick news headlines. First, Coal India has filed draft papers to list its subsidiary Central Mine Planning and Design Institute Limited, marking a key step in its divestment strategy. According to the draft prospectus, the IPO will be an offer for sale of up to 71.4 million shares with no fresh equity issuance by the subsidiary. Second, the Indian government has reinstated the remission of duties and taxes on exported products scheme effective June 1st to boost export competitiveness. Initially introduced on 1st January 2021, this scheme was paused on 5th February this year for a policy review. Third and the final one for the day, VST Tillers and Tractors has announced the development of two fully electric agri-machinery products, a power tiller and a weeder, slated for market launch in FY 2026. Both these products are being developed in-house and they come after 3 years of supplying electric drivetrain components to US-based Monarch Tractor. In FY 2025, VST sold about 37,300 power tillers, which is up from about 36,500 units in the previous year, while weeder sales jumped 63% year-on-year to about 7,500 units. That's all the news and stories I have for you today. I hope you enjoyed this show. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.